Before you assume lower interest rates are right around the corner, there's something important you need to know. The Federal Reserve just held interest rates steady, but the real story isn't what they did, it's what they signaled. Some Fed officials now believe rates could stay higher for longer, and a few even see the possibility of another rate hike if inflation doesn't cool down. Why does that matter? Because higher rates affect your money in very different ways. If you're saving, you might benefit from better returns. But if you're carrying debt, buying a home, financing a car, or using credit cards, higher rates can cost you a lot more than you realize. The biggest mistake people make is planning their finances based on what they hope rates will do instead of what rates are doing right now. The Fed says the economy is still growing, jobs remain strong, and inflation is still above its 2% target. In other words, they don't see enough evidence yet to start cutting rates. And that's why your bills still feel expensive. Even though rates didn't go up, they're still high. And high rates continue to impact borrowing costs across the financial system. Let's start with credit cards. This is where many households feel the most pain. Average credit card APRs are hovering around 21%, and some new cards charge even more. That means carrying a balance is extremely expensive. If you owe $4,000 on a card and only make minimum payments, interest can keep that debt hanging around for years. Instead of waiting for rates to fall, consider calling your card issuer to request a lower APR, exploring balance transfer options, or checking rates at local credit unions. Now let's talk mortgages. The Fed doesn't directly control mortgage rates, but its decisions influence them. Right now, the average 30-year fixed mortgage rate is sitting around 6.5%. That may sound normal compared to recent highs, but it still creates a significant monthly payment for homebuyers. Before buying a house, run the numbers using today's rates, not the rates you hope you'll get later. If the payment only works because you're expecting future rate cuts, that's a risky bet. On the bright side, savers finally have something to smile about. Many high-yield savings accounts are paying around 4% or more. That's a huge difference compared to traditional savings accounts that often pay next to nothing. If your emergency fund is sitting in a low-paying account, it may be worth shopping around. Just make sure the account is insured, watch out for fees, and check whether the advertised rate comes with conditions. Auto loans are another area where higher rates continue to hurt. New car loans are averaging close to 7%, while used car loans can exceed 10%. Dealerships often focus your attention on the monthly payment, but that's not the whole story. Always look at the interest rate, loan term, total loan cost, and total interest paid. A lower monthly payment doesn't necessarily mean you're getting a better deal. So why is the Fed keeping rates this high? Their goal is simple: bring inflation back down without causing major damage to the job market. Right now, inflation remains stubbornly above target, while employment remains relatively strong. That gives the Fed little reason to rush into rate cuts. The bottom line: don't make financial decisions based on predictions. If you have high interest debt, tackle it now. If you're buying a home or car, make sure the payments fit comfortably into your budget today. If you're holding cash, make sure it's earning a competitive return. And if you're investing for the long term, don't let one Fed meeting change your entire strategy. The smartest question isn't, what will the Fed do next? It's, can my budget handle today's reality if rates stay high for longer? That's the question that protects your money. If you found this video helpful, hit the like button, subscribe for more personal finance updates, and share this video with someone who's making a big money decision right now. And let me know in the comments, do you think the Fed will cut rates this year, or are higher rates here to stay? Thanks for watching, and I'll see you in the next video.